and welcome back to Duca's Copy TV. Now, it seems everywhere we look in the world today, there is some kind of economic slowdown, whether it's the uncertain times for the US economy, Japanese GDP concerns, or of course the crisis in Europe. There's something around the world for everyone, it seems. Joining me in the studio today is Vice President of Mirabaud, Yann Schorderet. Yann, thank you very much for coming into the studio.
Thank you for having me.
Obviously, our theme today is on the world economy, and particularly we're focusing as well on asset allocation. Yann, firstly, what's happening to the world economy from your eyes, from your point of view?
So, on average, so far this year, economic growth has been slowing around the globe. If we look at the three major economies in the world, that is the United States, the Eurozone as a whole, and China, we have seen economic growth statistics declining over the last 6 months. For a start, the Eurozone is still in the middle of a recession. The United States are growing, however, at a pretty modest pace, and China has just released its lowest figures of economic expansion since the end of the Great Recession that struck the world economy in 2008.
So, why has it been such a synchronized slowdown?
Interestingly, the reasons are different and depend on which country is considered, but they are somehow interconnected. From a financial standpoint, the essential reason is too much leverage. It was the case with the subprime crisis in the United States, too much leverage in the private sector. It is obviously the case with the sovereign debt crisis in the Eurozone, too much leverage, but this time in the public sector. From an economic standpoint, the fact that some Western countries are now in a difficult situation impacts the pace of economic growth of some typically export-driven developing countries.
You mentioned economic growth there, so what are we looking at then regarding economic growth going forward?
We expect growth to be boosted by stimulus measures. But more importantly, we expect growth to be boosted by emerging markets. The good news is that emerging countries have room for further steps in easing monetary policies, as well as expansive fiscal policies. Indeed, by contrast to most developed nations, interest rates in developing countries are still relatively high, and debt levels were relatively low. So in other words, rates can be cut and debt can be raised. Admittedly, this might only provide support to growth in the short run. And fundamentally, what is needed, what is required in the long run, is to rebalance the global economy. So those who were in the habit of consuming using leverage will have to become more competitive. And those who were in the habit of producing but saving will have to spend more.
So has a trend to rebalance the economy started already?
We are now seeing signs of changes in some of the important variables that should contribute to this trend. For instance, wage increases in China or Germany should strengthen the domestic demand in these two countries. Obviously, foreign exchange rates still constitute the easiest and the fastest way to influence international trade. In that regard, it is not surprising to have seen US officials insisting on China to let the Chinese currency, the renminbi, appreciate against the dollar. And to some extent, this explains why industrial production in the US has been doing so well recently.
Let's move on to asset allocation. What does this all mean in terms of asset allocation, Yann?
It means that those who are very risk averse or have strong liquidity needs will remain heavily invested in cash. But for those who have longer time horizon, interesting opportunities exist in risk assets. If you don't believe the worst case scenario is just around the corner, equities are attractive from a valuation perspective, and especially if you compare to safe haven bets like treasuries in the United States, in Germany, or even in Switzerland. In these countries, government bond yields are now standing at historical lows, and at these levels they are pricing a severe recession or even a depression. So in conclusion, being invested in equities somehow makes sense if you don't think that the Eurozone is going to collapse, or if it does, that it will happen in an orderly manner. In addition, I would say that high-yield bonds perform usually reasonably well in a low growth and low inflation environment. Having said that, risk-reward ratios will remain relatively low because of the high volatility that is likely to prevail in the market, and consequently, we still recommend being cautious in allocating capital.
Yann, thank you very much for coming into the studio today for that. That's all we've got time for here on Duca's Copy TV. Stay with us though, we will have John Hancock from the World Trade Organization in the studio later, but until then, goodbye.